I was still working when I turned 62, so I wasn't going to claim Social Security then because I didn't need the money, and I knew that if I worked until I was at least 66, I would get more.
You gain so much more in terms of what your income is going to be in the out years by waiting to the retirement age, at least, wait until 66. And in my case, I waited till I was 69.
I don't regret waiting until I'm 70 to collect Social Security. It was the wisest move I've made.
For millions of Americans standing on the threshold of retirement or already collecting benefits, the prevailing concern extends beyond simply making ends meet on a fixed pension. The critical question is how to remain active in the workforce and supplement income without inadvertently violating complex federal financial regulations. In an economic landscape where inflation has cooled, yet prices remain stubbornly high, the need to re-enter the labor market or maintain part-time employment has become a financial imperative for many senior households. Consequently, the latest announcement regarding fiscal year 2026 income limits from the Social Security Administration, SSA, has moved to the center of public attention, as these figures will directly dictate whether workers will face benefit withholding as they strive to bridge their financial gaps. The comprehensive policy landscape for the upcoming year was crystallized through official documents released in late October 2025. On October 24, 2025, the SSA issued a pivotal notification establishing the new regulations effective January 1, 2026. In this press release, Commissioner Frank J. Bisignano confirmed a 2.8% cost of living adjustment, COLA. However, paramount for the working retired are the adjustments to the earnings test thresholds. These federal mandates govern the relationship between labor income and benefit eligibility. Grasping these precise figures is essential not only to avoid unexpected penalties, but also to optimize personal financial strategies for the year ahead. State-level agencies, such as the California Department of Developmental Services, also updated these datasets on November 20, 2025, to guide local enforcement, creating a unified legal framework from the federal level down to the states. Delving into the specifics of the 2026 earnings test mechanism, it is crucial to analyze the two distinct tiers established by the SSA, dependent on the beneficiary's age relative to their full retirement age. According to the official SSA fact sheet released on October 24th, for beneficiaries who will not reach their full retirement age within the 2026 calendar year, the allowable earnings limit has been raised to $24,480 annually. This equates to an average of approximately $2,040 per month. This represents a significant easing compared to the previous year, providing more latitude for seniors engaging in part-time work. However, the withholding rule remains stringent. If wage income exceeds this $24,480 threshold, the SSA will withhold $1 in benefits for every $2 earned above the limit. This presents a calculated challenge for workers, necessitating close monitoring of pay stubs to avoid crossing this red line and disrupting their monthly benefit stream. The second tier applies to the specific cohort attaining full retirement age during 2026. For this group, federal regulations are notably more lenient, designed to encourage continued workforce participation in the months leading up to retirement. The earnings cap for this demographic has been set at $65,160 annually, or $5,430 per month. Not only is the limit higher, but the penalty is also reduced to $1 withheld for every $3 earned above the limit. This earnings test applies solely to income earned in the months prior to their birthday month. Once the beneficiary officially reaches full retirement age, all income limits are permanently lifted, allowing them to collect both their full salary and full benefits with zero withholding. To fully understand the impact of these figures, one must reference the shifting definition of full retirement age. A Kiplinger financial analysis published on October 27, 2025, highlights that for individuals born in 1959, the FRA increases to 66 years and 10 months in 2026. This implies that the duration during which they are subject to the restrictive $24,480 earnings test will be prolonged compared to previous generations. This shift in the FRA is a pivotal factor workers must account for when retirement planning, as it dictates exactly when they will be liberated from earnings caps. The gradual increase in the retirement age also reflects government efforts to balance the budget and ensure the long-term solvency of the Social Security trust funds amidst an aging population. Another fiscal pivot for 2026 involves the Social Security taxable maximum. According to the SSA and a report by the tax advisor on October 24, 2025, the maximum amount of earnings subject to the Social Security tax will rise to $184,500, up from $176,100 the previous year. While this doesn't directly trigger benefit reductions under the earnings test, it impacts the net income of high earners remaining in the workforce. Under this new cap, an additional $8,400 of income will be subject to taxation. The tax advisor estimates that for self-employed individuals, the maximum tax liability could reach approximately $22,878, a substantial figure requiring careful financial preparation. From a macroeconomic perspective, these adjustments carry wide-ranging implications for the labor market. A NASDAQ report on October 29, 2025, suggests that raising the earnings limit to $24,480 incentivizes older adults to participate in the workforce, particularly in sectors facing acute labor shortages such as services, retail, and healthcare. For many employers, this experienced labor pool is invaluable, and the new SSA policies partially dismantle psychological barriers, giving seniors more confidence to sign part-time contracts. However, the report also warns of the first year of retirement rule and other complex regulations workers must navigate to avoid administrative complications. Dispelling a common and damaging misconception, Investopedia clarified the nature of withheld benefits in an article dated October 24, 2025. Many beneficiaries mistakenly believe that money withheld due to exceeding income limits is lost forever to the state treasury. In reality, the withholding is merely a deferral. Once the worker reaches full retirement age, the SSA recalculates their monthly benefit amount to credit back the previously withheld funds. This means that in the aggregate, beneficiaries will recover these funds in the form of higher monthly payments for the rest of their lives, a critical detail for journalists and financial advisors to emphasize. Furthermore, the AARP, the American Association of Retired Persons, weighed in on October 28, 2025, to underscore a vital distinction regarding income definition. The organization clarified that the $24,800 limit applies strictly to wages and net earnings from self-employment. Passive income sources, such as interest from savings, dividends from stock investments, capital gains, or pensions from other sources, do not count toward this limit. This distinction allows retirees with diverse investment portfolios to rest assured that their accumulated assets will not negatively impact their Social Security eligibility. Regarding the implementation timeline, the public must mark key dates. Following standard protocol, beginning in December 2025, the SSA will dispatch official personalized notices by mail and update the My Social Security online portals. The new regulations, including the $24,800 and $65,160 limits, will become effective on January 1, 2026. This is the definitive moment for finalizing work schedules and salary negotiations. Workers are urged to proactively communicate with employers to ensure their income does not inadvertently breach permissible thresholds if they wish to preserve their full checks from the start of the year. In summary, balancing work and Social Security in 2026 demands a calculated strategy and a deep understanding of the new federal guidelines. The eased income limits offer a positive signal for those under full retirement age, while the recoupment mechanism and investment income exemptions provide a safety net for rights protection. By staying informed through official channels like SSA.gov and reputable organizations, beneficiaries can find the optimal equilibrium between workforce contribution and maximizing the Social Security benefits they have earned over a lifetime.